Joining us now to discuss which tech companies could be hurt most by the US-China trade war, we've got David Traynor from New Constructs and Max Wolf from Multivariate. A very good afternoon to you both. David, if I start with you, clearly Apple could be hurt in terms of sales and costs by tariffs. Have they been hurt already by IP theft or any of the other accusations that are out there?
That's right, Mike. I think you make a really good point. You know, the benefits.
It's Wilf, not Mike.
Oh, sorry.
No worries.
Blame your producers for that one.
You can't let someone else take credit.
Yeah, that's right. Look, I think the long-term impact of IP theft is way bigger than tariffs, and I think we got to get the IP protection right. And tariffs is really just a short-term sensationalism of what is really covering up a bigger issue with respect to IP protection. We're dealing with a culture in China that has never really been about innovation, right? They're the fast follower. They're the copycatter. They don't know how to innovate. And so they rely on this stealing of IP to grow their economy. And so this is a really difficult issue that we have to tackle at some point. And the longer we put it off, the more pain we're going to have to deal with in getting things back to a fairer place.
Max, can you own Apple going into this weekend with so much at stake on these trade talks?
Sure, you can always own it. It's got a lot of appeal on a number of levels, although it certainly had a rough run. I think there's going to be some bumps in the road coming up. Obviously, I think the trade news is going to be a major concern across the tech space. And I would highlight that for us, when we try to break down the risks and the rewards here, there are companies that have major exposure because they produce and export from China. And there are companies that have both that and the exposure of needing to sell into China. And part of what I think the tariff debate has done is showed us we need to update our opinions. So China is about to become one of trying to be the global leader in AI, is a leader in a whole bunch of basic online and e-commerce and financial technology space activities, and is important both as a producer but also a consumer of the goods and services coming from American companies, including tech companies. And it's a vital part of the growth story for a lot of the national champions, or I think that the terminology for Breyer there was treasures, that we invest in and that dominate our market-weighted indexes, where we've crowded our investment dollars in the ETF age here. So I think very important on a number of levels.
Max, which are the other big U.S. companies that you think are going to be hit hard or harder by this debate that haven't perhaps seen that share price fall yet?
So we're pretty concerned about Hewlett-Packard, HPQ here, and some of the others. Particularly, we think at risk are the names where there are national champions in China, such as Huawei and some of the other names that the Chinese would like to promote through a number of means, including sort of promotion of national champions. And if we look at the history of various nations that have experienced trade difficulty with China, we don't need to look that much further than some recent difficulties that South Korea-based companies had, and where we've seen that the real risk exposure for international companies having difficulty in their trade relations with the Chinese are not always restricted to tariffs, but also non-tariff barriers. Campaigns against foreign companies and foreign interests have proved very effective and painful. And for instance, there are multiple South Korean industries still reeling from 3- and 4-year-old non-tariff trade disputes with the Chinese authorities that resulted in non-tariff barriers being quite problematic for those companies in the largest growth market in the world.
David, just wanted to go to one company that you flagged as potentially being at risk, which would be Starbucks. And it's interesting because so far it's been kind of insulated, and I think there's been some assumption that the Chinese authorities would be loath to kind of clamp down on anything that their own consumers would feel as if it's a luxury. It's a way of kind of aspiring to a better lifestyle. Do you actually see Starbucks as potentially at risk in this whole trade fight?
Yeah, I think as was just pointed out, look, anything that the Chinese think that they can or may do on their own, they're going to favor those internal or those local indigenous national champions in the long term. China wants to see China be successful. They don't necessarily need to see any U.S. companies be successful. So really, if to navigate China well, you have to look for companies, just as you do in all investing, really, that have sustainable, really strong competitive advantages. And at the end of the day, Chinese people could get coffee from just about any place. There's not necessarily anything sort of sustainable about making coffee or making phones for Apple, for example, or the glass and Corning. It's about those businesses that have something that can compete with China, because at the end of the day, we are competing with them and their internal national champions, whom they will favor a great deal or as much as they can when the chips are down.
All right, we'll see what happens this weekend. Guys, thank you for weighing in on the stock market impact. David Traynor and Max Wolf. Up next,